Investing isn't about guessing the future. It's about positioning yourself to succeed when opportunity strikes. Think of it as a game of patience, not prediction. In a world where everyone is chasing the next big thing, the true winners are those who take the time to understand, to analyze, and most importantly, to wait for the right moment to act. But here is the catch. Waiting doesn't mean sitting idly by. It means being prepared, knowing exactly what to look for when the moment arrives. So when is the best time to invest? It's not a single moment. It's a mindset, and it's one that will set you apart from the rest. As we move forward in this unpredictable world, let's first focus on what really matters. We've already established that investing isn't about perfect timing. It is about being prepared when opportunities arise. And with that preparation, the first rule comes into play. Be patient, not predictive. In the world of investing, impatience often leads to mistakes. Too many investors get caught up in the frenzy of predicting the future, when, in fact, the future is incredibly difficult to predict. The truth is, markets don't follow a predictable path. They are constantly fluctuating, reacting to countless variables, many of which are beyond our control. Trying to time the market with precision is a fool's game. It's important to understand that investing is not a sprint, it's a marathon. What separates successful investors from the rest is their ability to wait for the right opportunities instead of forcing themselves into the market at every turn. Investors who focus on long-term growth, compounding, and a steady hand in times of market turbulence often outperform those who try to chase every little trend. If you look at history, you'll see that the wealthiest investors are not the ones who have jumped in and out of the market based on short-term shifts. They are the ones who have waited patiently for the market to present the right opportunities and have invested when the time was right. Waiting isn't passive, though. It's about continuously learning, analyzing, and keeping your mind open to the possibilities that could present themselves. This kind of patience is not easy. It's difficult to sit back while everyone around you is caught up in the whirlwind of speculation, buying and selling based on the latest headlines or breaking news. But real investors understand that most of the noise in the market is just that noise. It doesn't serve your long-term goals. So how does patience translate into success? It means you understand the power of compounding. When you allow your investments to grow over time, you're not just making money. You're letting your money make money. The longer you allow your investments to grow, the more you benefit from this process. Compounding is the eighth wonder of the world, as they say, and it's the key to building wealth over time. What does this look like in practice? Let's say you invest in a quality company that's undervalued, and instead of worrying about the short-term fluctuations in the stock price, you hold on to that investment. Over time, the company grows, earnings rise, and its stock price reflects the true value. You've given your investment time to mature, and in doing so, you've allowed it to compound and multiply. In contrast, those who lack patience often sell too early, missing out on this compounding effect. They allow the market's noise to distract them, and in doing so, they miss out on the true value that long-term investing can offer. The real money in investing isn't made in the short term. It's made by holding on to quality investments over time. But let's not get ahead of ourselves. Patience alone is not enough. The second key point, the one that separates the successful from the unsuccessful, is knowing when to invest, especially in times of fear. The best opportunities often come when everyone else is scared. The best time to invest is when others are fearful. This might sound counterintuitive, but it's one of the most critical lessons you can learn as an investor. When the market is in panic mode, stocks are sold off indiscriminately. Prices drop, fear spreads, and emotions run high. But here's the thing. It's during these times that the greatest opportunities are often created. When the crowd panics and flees, it's often the savvy investor who steps in and buys. Why? Because panic leads to irrational behavior, and irrational behavior often causes great companies to be sold for far less than they are worth. If you have done your homework, if you have analyzed the fundamentals, then fear is your opportunity. It's your chance to buy quality assets at a fraction of their true value. Think about it. When everyone else is selling, that's when the smart money should be buying, of course. It's easier said than done. Fear is a powerful emotion, and it can cloud our judgment. But the reality is, fear often drives prices to irrational lows, which creates an opportunity for those who are willing to act. The key is to have a clear understanding of what you're investing in. This is where preparation meets opportunity. When you know the fundamentals of a business, when you understand its long-term prospects, and when you're confident in its value, market fear becomes your friend. Let me give you an example. The financial crisis was a time of widespread panic. Stock prices plummeted, banks failed, and everyone was predicting the end of the financial world. But during that time, some of the smartest investors were quietly buying up stocks at bargain prices. Those investors didn't panic. They saw the opportunity. They understood that the market's temporary fear didn't change the long-term value of many companies. And as a result, they made substantial gains over time. This is the essence of contrarian investing. While the rest of the market is running in fear, you stand firm, knowing that your long-term success doesn't depend on the fear of others. It depends on your ability to identify opportunities when they arise, and your willingness to act when everyone else is too scared to do so. Investing is a lot like picking winners in any area of life. It's not about being the loudest voice in the room or chasing the latest trend. It's about finding something solid, something that can withstand the tests of time. In investing, that means focusing on quality businesses, quality assets, and quality opportunities. You see, there's a tendency in markets for investors to get swept up in the hype of popular trends. This happens all the time. People are enamored with the next hot stock, the next big tech company, the next shiny object. But here's the truth. Most of the time, the hype is just that. Hype, it's not substance. It's a distraction. Real wealth is built by investing in high-quality companies and assets, ones that are fundamentally strong and that have proven their ability to perform over time. When you focus on quality, you are less likely to be swayed by market sentiment or short-term volatility. High-quality businesses are built to last, and their value compounds over time, often outpacing the latest trend. Take, for example, a company with a strong balance sheet, consistent revenue growth, and a solid competitive advantage. These are the kinds of businesses you want to be investing in. They are not always the most exciting or flashy, but they are the ones that can weather economic downturns, adapt to changing environments, and continue to provide value to their shareholders year after year. Look at companies like Coca-Cola or Johnson & Johnson. These are examples of businesses with enduring value. These companies have been around for decades, and despite market fluctuations, they have managed to stay relevant and continue growing. What do they all have in common? A focus on quality. Now, don't get me wrong, there's nothing wrong with looking for growth opportunities. But the key is to separate the wheat from the chaff. You have to be able to tell the difference between a company with long-term potential and a company that's riding the waves of short-term popularity. And that requires diligent research, a clear understanding of the fundamentals, and an ability to look beyond the surface. When it comes to choosing what to invest in, always prioritize quality over popularity. Quality investments will provide a more reliable path to wealth. They may not always be as exciting in the short term, but in the long run, they are the ones that generate real value. By focusing on quality, you ensure that your investments are built on solid foundations. Quality businesses have strong management teams, clear growth strategies, and a track record of adapting to market changes. They can weather economic cycles, industry disruptions, and changing consumer preferences. They provide a level of certainty that lower quality, trend-driven investments simply cannot. The beauty of investing in quality companies is that their success is not contingent on market sentiment or speculative trends. You don't have to worry about the latest news cycle or the next big thing in tech. Instead, you focus on companies that have built something lasting, something that will continue to deliver returns regardless of what the broader market is doing. In practice, focusing on quality means investing in businesses with a solid business model, a strong financial position, and a capable management team. This approach takes emotion out of investing and helps you avoid the pitfalls of chasing after short-term gains that ultimately don't last. If there's one thing that separates successful investors from the rest, it's the ability to tune out the noise every day. We're bombarded with information. from headlines, from social media, from analysts who seem to have an opinion on everything. The news cycle moves at a dizzying pace, and it's easy to get caught up in it. But here's the thing. Most of the noise is irrelevant to long-term investing. The market is constantly in flux, and so are the opinions of the people who follow it. But if you're looking to build long-term wealth, you need to focus on what truly matters. The fundamentals of the companies you're investing in, not the latest headlines or speculative trends. Think about how often you see a stock price jump or fall in response to an earnings report or some piece of news. In the short term, the market is reactionary, driven by emotions, expectations, and often little more than speculation. The latest earnings miss or beat can send stocks soaring or crashing, even though it may have little to do with the underlying health of the company in the long run. Investors who are caught up in this short-term noise can make costly mistakes. They may buy stocks based on hype or sell them based on fear, decisions driven by emotion rather than sound analysis. But if you ignore the noise and stay focused on your long-term goals, you can avoid this emotional roller coaster. This is where having a solid investment strategy becomes invaluable. If you know what you are looking for in a company, strong financials, consistent performance, good management, you can ignore the distractions of the market. When the headlines are all doom and gloom, and the market is reacting to every tweet or news report, you stay calm, stick to your strategy, and keep your eyes on the bigger picture. Ignoring the noise also means not falling for the temptation of short-term trading. Many investors are drawn to the idea of quick profits, but this mindset often leads to poor decision making. If you're constantly trying to time the market, you're likely to make mistakes. The market is unpredictable in the short term, and trying to predict the next big move is a fool's game. The true money is made by sticking to your principles, ignoring the hype, and holding on to investments for the long term. So how do you do this in practice? It comes down to discipline. You need to develop a system for filtering out the noise. This means not reacting to every market fluctuation, not buying into every trend that's popular at the moment, and not getting distracted by every new piece of information. Stay focused on your long-term strategy and resist the urge to make impulsive decisions based on short-term movements. By ignoring the noise, you also allow your investments to grow undisturbed by the daily fluctuations of the market. You're able to take a longer view and make decisions based on the fundamentals rather than the noise. And ultimately, that's what leads to success in investing. The ability to stay the course when everyone else is panicking or chasing the next big thing. Investing, at its core, is a decision-making process. The ability to make informed, independent decisions is what separates the successful from the unsuccessful. So many investors fall into the trap of following the crowd, listening to the pundits, and making decisions based on what everyone else is doing. But here's the harsh truth. The crowd is often wrong. It's easy to get swept up in the prevailing sentiment, especially when the media and social networks are full of voices telling you what to do. Whether it's the latest stock tip or the so-called next big thing, the temptation to follow others is strong, but doing so often leads to poor decisions. That's why it's critical to develop the skill of thinking for yourself. Thinking for yourself doesn't mean you reject all advice. It doesn't mean you ignore the insights of others or dismiss what's happening in the world. Rather, it means that you take all the information you're given and critically analyze it. It means forming your own opinion based on facts, research, and sound reasoning. And most importantly, it means being willing to make decisions that might be unpopular or counter to the prevailing sentiment. One of the biggest mistakes investors make is simply following the crowd. It's human nature to want to fit in, to go with the flow, and to feel safe by doing what everyone else is doing. This is why so many investors pile into a hot stock when everyone else is buying. They think, if everyone else is doing it, it must be the right move. But this herd mentality often leads to poor outcomes. It creates bubbles. Prices get pushed up beyond their intrinsic value, driven not by fundamentals, but by speculation and hype. And eventually, these bubbles burst, leaving those who followed the crowd holding the bag. Consider the tech bubble of the late 1990s or the housing bubble in the mid-2000s. In both cases, there was a massive influx of investors jumping on the bandwagon, driven by the belief that these markets would continue to rise indefinitely. But when the bubbles burst, many investors lost their fortunes because they didn't stop to think for themselves. They didn't analyze the underlying value of their investments. They simply followed the crowd. The lesson here is clear. Just because everyone else is doing it doesn't mean it's the right thing to do. In fact, it's often a signal that it's time to pull back, reassess, and think critically about the situation. On the other hand, independent thinking is the key to successful investing. When you think for yourself, you're not swayed by the emotions or opinions of others. You make decisions based on your own analysis and your own understanding of the market. This gives you an advantage, especially in times of market uncertainty or volatility. Take, for instance, Warren Buffett's approach to investing. He's famously known for making decisions that are often contrary to the prevailing wisdom during times of market panic. When others are selling, he's buying. When others are chasing the latest trend, he's sticking to his well-established principles of value investing. Buffett doesn't follow the crowd. He doesn't get caught up in the hype. Instead, he takes a methodical approach to investing, grounded in research, patience, and a focus on long-term value. And this independent thinking has led to decades of consistent returns. This doesn't mean you should ignore expert advice or avoid learning from others. On the contrary, independent thinking involves gathering all the information you can, whether it's from analysts, industry experts, or your own research, and using it to form your own opinion. It's about developing the confidence to trust your judgment, even if that judgment goes against the grain. So how do you cultivate this ability to think for yourself as an investor? It begins with educating yourself. Knowledge is the foundation of independent thinking. The more you understand about the companies, industries, and markets you're investing in, the better equipped you'll be to make informed decisions. But education isn't just about reading the latest market news or listening to financial podcasts. It's about digging deeper, questioning assumptions, and learning to think critically. You need to understand not just the what of an investment, but the why is this company a good investment? Why is the market behaving the way it is? What are the underlying drivers of value? This kind of thinking takes time, and it requires patience. It's not something that can be rushed. But over time, as you develop a deeper understanding of the markets and the investments you're making, you'll become better at making decisions based on reason rather than emotion or external influence. Another key to independent thinking is developing the discipline to stick to your plan. The market will always try to tempt you with the next shiny object. It will offer you the latest hot stock or the newest investment trend. But if you've done your homework, if you've created a plan based on your own research and understanding, then you need to stick to it. Trust your analysis, trust your process, and stay the course. Independent thinking also requires emotional discipline. The market can be a roller coaster ride. Prices rise and fall. News events shake things up, and emotions run high. But in these moments, your ability to remain calm and think clearly will set you apart. When the market is volatile and fear is running high, that's when independent thinking is most valuable. By controlling your emotions, you can avoid making impulsive decisions based on fear or greed. Instead, you can stay focused on your long-term goals, knowing that the best opportunities often come when others are fearful or uncertain. The best time to invest isn't when the market is telling you to act. It's when you've done the work. You've analyzed the fundamentals, and you've formed your own independent judgment about the value of an asset. Independent thinking is the key to successful investing. It's about making decisions that are grounded in reason rather than emotion or crowd mentality. By thinking for yourself, you'll avoid the mistakes that so many others make, and you'll be better positioned to make sound, long-term investment decisions. In a world that's full of noise and distractions, the ability to think for yourself is your most powerful tool. So take the time to learn, develop your own strategy, and trust your judgment. When you do, you'll be on the path to investment success.